Hi, this is Leo Malmasi, and this is a data-driven approach to investing in restaurant business. So the first thing we want to look at is finding a location. What we're going to look at is population by state and population growth by state from the Census Bureau. So looking at state populations, we can quickly identify California and Texas as the two highest. And for population growth, looking at California and Texas, we can see here California is just a little bit higher than the average, though Texas is quite a bit higher than the average. So Texas is the, the target state we're going to start looking at. So choosing Texas as the state to uh, buy a business, we're going to look at restaurant competition by city. So here we can, and the reason we want to take restaurant competition by city is that we want to know that these cities have an interest in the fast food chain. So looking at the top 10 cities, we can take the restaurants that these cities have and rank them by competition to identify what people are most interested in these top cities. So here are the top restaurants, and we can break it down into uh, the top five and bottom five. And the way we're going to measure the top five and bottom five are going to be by return on equity, which is the profitability of the company and their investors, the return on assets, which is the overall profit margin of products, and the cost effectiveness of the equipment, or essentially how if whether or not the equipment can pay for itself. And then finally, asset turnover, which is the volume at which the company sells their products. And then after that, we're going to look at market saturation by restaurant. And what that's going to do is kind of help frame uh, these other financial numbers and whether it makes sense to compete with the rest of the market if the market is too saturated or not. So just to take a quick look, um, these are the top five and bottom five companies that we're looking at, and also a sneak peek at the market saturation. So return on equity, you can quickly identify this one shooting up, which is Starbucks, very well, or performing very well. McDonald's uh, having a good year, 2017, and then quickly returning to the market average. um, Here we can see Sonics represented here. From 2015 to 2016, you can see that they're making higher highs and higher lows, which indicates that they're having a controlled growth. Where with Starbucks, they're shooting way high, which they very well could again like return quickly to the market average. So seeing this controlled growth is a good sign. And then another company to take note of is Wingstop. They also show some slowed and controlled growth, which also suggests some stability. So, and then this one here, Papa John's, also had a good year, 2017, then quickly returned to the market average. So return on assets, you're going to see a pretty high correlation between return on assets and return on equity as they directly reflect each other. Though something of interest here is that uh, Papa John's stays with the market average with return on assets, meaning that their profitability or their profit margins um, have not increased in this 4-year period, though their return on equity had for some reason. And moving on to return on assets, or I'm sorry, asset turnover. Again, Starbucks outperforming everyone. Looking at Sonic this time, making somewhat of a slow descent. So their asset turnover, the volume that their sales is decreasing. Though they slowly started to slowly rise in 2018, but more of a downward trend. Then looking at Wingstop, they again have this slowed and controlled growth pattern of higher highs and higher lows. Actually, I think this is a higher high. This is a very low rate of change here. Now, Domino's Pizza, they also, on this top line, show some controlled growth. And that's something that we're interested in. We're interested in trying to identify some stable companies. So looking at the rate of change of all three of those financial metrics, you can see that McDonald's is the worst performing, and Starbucks, as you could probably guess without having to see this chart, is the best performing. So this is the metrics that we're going to use to identify the top 5 and bottom 5, which the bottom 5 would be McDonald's, Lubs, Wendy's, Wingstop, and Chipotle. The top 5 would be Papa John's, Jack in the Box, Wendy's, Domino's Pizza, and Starbucks. So even though Domino's Pizza, they're very low rate of change from that 4-year period, also kind of indicates some stability in their business model. Though it also indicates that their business model doesn't facilitate a lot of growth, at least for that 4-year period. But something interesting for Wingstop is that they have a growth for asset turnover, which for much of these companies are either negative or you can't see it, other than Starbucks, which is important because asset turnover is a leading indicator for the other financial metrics, the return on assets and return on equity, to also increase over time. But you would expect asset turnover to be the first one, sales volume to be the first one. So looking at competition now, once again, McDonald's is the worst performing, but is also has the highest competition. So those are 2 red flags that we want to avoid. So Sonic's, out of the 4 that look interesting, should be Sonic's, Domino's Pizza, Wingstop, and Starbucks. Sonic's is the highest competition. Though looking at the rate of change for the 4-year period, Sonic's doesn't appear to show any growth. So that might be a good indicator to go ahead and knock that out of the running. So it limits it to Domino's, Wingstop, and Starbucks. Domino's, there's a little bit more competition than the other 2. Wingstop and Starbucks being the the lowest competition. The Wingstop does have some negative growth in return on assets and return on equity. So that is one red flag that we need to be aware of. So down to recommendations for restaurants to invest in. First choice would obviously be Starbucks, the best performing in all categories, lowest competition, though some variables to consider for the location is Texas heat. It's, Starbucks sells hot coffee. Might not be the best place to try and sell hot coffee, which might also indicate low competition, even though you can just as easily order iced coffee. Something else that might indicate or explain low competition in Texas is that politics being associated with a brand, which has been somewhat of um, a practice among uh, most companies now. Starbucks has taken a political ideology and placed it as part of its brand, which happens to be almost polar opposites with the dominant Texas political ideology, uh, which can uh, which can create a lot of tension. So second choice is Domino's Pizza. Again, low competition, shows some signs of company growth and asset turnover, which is again a leading indicator for company growth in general. Though Domino's is probably one of the flattest company growth, which shows some stability. Um, and profits could be low and slow because of that slow growth, and associated with that slow growth could represent a high barrier to entry due to being able to um, create a positive cash flow due to the debt that you would expect to incur for buying a business, buying equipment, hiring staff, and maintaining licenses. Third choice is Wingstop. Again, low competition also shows some company growth and asset turnover, which is an indicator for company growth overall. Some cons could be a false reversal. The company uh, for the financial trends that we identified, they the control growth went up to uh, the market average, which does not necessarily show a lot of confidence behind the growth, though it is steadily growing with higher highs and higher lows, which does suggest sustainable growth. It's not out of control growth that could quickly drop. Um, but because of the negative ROE or return on equity and return on assets, financial trends um, could be years before seeing some positive cash flow for the business. So, in summary, first choice Starbucks has large company growth in all sectors, though there is some political climate to be aware of in the Texas location. Um, Domino's Pizza, second choice, stable company, stable uh, but limited growth. Wingstop, again, low competition, but does seem to have slow, controlled growth and sustainable growth, not growing too fast. Again, I'm Leo Malmasi, and this was a data driven approach to investing in a restaurant.